Hello, this is James Anderson with LBM Journal. I'm filling in for Rick Schumacher today, and I'd like to thank you for joining today's webinar, Can Your Business Fund Your Post-Ownership Goals? I'll hand the reins over in a couple minutes to succession planning guru Sam Brownell. Since successful owners typically reinvest heavily into their company, they often rely on the sale of their business as well as a sound financial plan to maintain their standard of living. In this webinar, Sam Brownell from Stratus Wealth Advisors will discuss the importance of planning to reach your post-ownership goals by increasing the value and marketability of your business, conducting a post-ownership cash flow analysis, and mitigating taxes on the sale. A little bit about Sam. He CBA, CFA, MBA, and has been a financial professional since 2006. When he formed Stratus Capital Management, actually he formed that in July 2013 to provide goals-based financial planning and investment management to individuals, families, and independent business owners. As the firm grew, an increasing number of independent business owners sought Sam's advice on their short and long-term planning needs, including valuation, tax strategy, business continuity planning, and succession planning. In 2019, Sam obtained the CBA certification from the National Association of Certified Valuators and Analysts in order to better serve the valuation and succession planning needs of independent owner clients. A couple of details before we get started. Everyone here is muted, so you can hear us, we can't hear you, however. If you're having technical issues, please click on the chat button at the bottom of the screen and we'll address those issues in real time. If you have any questions for Sam, click the Q&A button at the bottom of the screen and we'll address as many questions as possible during the presentation and also after. We do expect to finish in about 30 to 40 minutes. One question we often get, we are recording the webinars and we'll be sending a link afterwards to everyone who is registered, and that'll be coming later this afternoon. Today's webinar is sponsored by Stratus Wealth Advisors, and you can learn more about the company at stratuswealthadvisors.com, and you can meet Sam in person at the LBM Strategies Conference, which will be held October 12th through 14th in Denver. And if you haven't yet registered for that, I believe you can still register by the end of this month to save an additional $200 on registration. With that, I will turn it over to Sam.
Great. Thank you, James, and thank you to all the staff at LBM Journal. Really appreciate you all having me here. Looking forward to getting going today. This is really a follow-on to the webinar a couple months ago that I did with John Wagner, all about effective succession planning strategies. And so as we drill down a little bit and we start talking about some of the details, one of those big details is, can my business fund my post-ownership goals? And then, of course, how do I do that in a tax-efficient manner? And as we know, any type of transaction, when anything of value changes hands, there's probably going to be taxes associated with it. And so the question is, how do you mitigate it to the extent possible? And what do you pay now versus what do you pay later? And so that's really what we're going to dive into today. Just a brief background. And as James said, we will be at the LBM Strategies Conference in October. So looking forward to meeting folks in person there. But we are a firm that focuses in the independent LBM space. We do a lot of work with your peers, business valuation, everything from gift and estate tax valuations to updating buy-sell agreements to M&A type work. And we work very closely with folks like John Wagner, who will actually put the transaction together, and then we'll work around to get you ready, and then for the posts piece to make sure that you are in good shape coming out of that transaction. And then really it's the coordination and making sure that succession planning is such a complicated field, and you as a business owner already have a ton of work on your plate. So being able to coordinate and run alongside you here so that this doesn't become another thing on the to-do list, we think that's really important, because most folks that we have worked with have only sold their business one time. And so we want to make sure we get this right, and we want to make sure that it's not something that gets in the way of the day-to-day functioning of the business, because that's really critical. Because at the end of the day, we want to be able to drive good profitability, good cash flow. So without further ado, I'm going to jump in here, and as we've done in the past, try to share a little cartoon, which will hopefully stick with you. But the point here of this cartoon is that most people have heard of succession planning. Most people have seen somebody who's exited their business, but is it really as easy as it looks? No. And also, it tends to be something that folks don't really think about until they absolutely need to. It becomes a crisis. An owner has a heart attack, or, oh my gosh, my kids actually don't want the business. What am I going to do? Or, geez, I haven't put anything in my retirement account. I've been really trying to get my kids through school. I've been trying to make sure that my business is growing. Man, I'm going to have to work at this forever. And so what we want to do with this planning process is start early enough so we don't end up like this gentleman here who's thinking that, well, I'm going to have a couple more kids because that's really going to be what saves me when I get to retirement. So it's really important that the planning process start early. And we'll go through that today and talk about what that time period is. But we like to say 3 to 5 years, even if it means that you're not doing a whole ton in terms of the actual sale and transaction. You need to be thinking through things like, what's my business worth now? Can that plus my other assets really fund my lifestyle? If not, what do I do? And just in general, how do I make the business more marketable? So let's move forward here. And it's really that cartoon was a good segue. And we shared this during the last presentation, which is, it's not like it was a generation ago. Right? When many of the LBM owners were coming into ownership, it was generally through a family business. And we're not seeing that now the way we did 30, 40 years ago. And so that means that for those of you who are lucky enough to have family to pass the business to, that's wonderful. There's still lots of planning strategies that can go into that to make sure that we're mitigating taxes and make sure we've got some continuity in leadership and all the important things to make sure that the business functions. But for those of you who don't have that option, don't panic, right? There are lots of different ways we can go, different ways that the sale can be structured. And even if the M&A market, which has been red hot up to now, starts to slow down, that still doesn't mean that you have to wait until the next hot cycle in the M&A market. There are other things that you can do to either prepare yourself for that next uptick in the M&A market or to actually start transitioning ownership of your business. So one of the things that we find a lot is a business is worth a certain amount of money. And it's typically a surprise to a lot of owners that it's not worth more. And that's because a business, just like when you're buying a house or really any large good, it's what the buyer sees in it that's going to really matter. And so in terms of maximizing the value of your business, there are a number of things that we can do. And so we're going to walk through these step by step and get a little bit more into detail on them. But the first is to diversify the decision-making process. And what we mean by that is you own your business. You've been running the business for decades. You probably have built great relationships with your vendors, with your customers. You're probably involved in most of the big decisions. You're the one who reaches out to the bank if you need a loan. All of these critical business decisions, setting the strategy, coming up with the hiring practices, working with your management team, running board meetings, all of these things are very, very critical to the business. But if they're stuck with one person, then that business isn't worth very much to me. If I buy your business and the only person who is in contact with the bank or in contact with your top 10 customers is a person who's going to be leaving at some point, and as soon as that person leaves, what happens? Does the management team know how to run the business? And so a big key, and the earlier you start, the better, because it's very emotionally driven, is thinking about what decisions can I start delegating to other people in my management. And I'll give you a good example, which is a lot of the owners we work with, the insurance review is still done by the owner. That's something that can probably be passed off fairly easily to somebody else. And they can sit down with your insurance advisor and they can go through. And as we all know, given the volatility of input prices, right, lumber prices in particular, insurance is bouncing all over the place. So you need to have good contact with these folks, but that's something you can start turning over. And then whoever you put on your management team to be in charge of that insurance review process, they can write a short memo that you can then just review. And so as you start to take a step back, look for some of the low-hanging fruit, so to speak, before you get into some of the more challenging. And purchasing is a big one we hear about, because you as the owner may be the one who's doing the purchasing. You've come up with these strategies for how to manage volatile markets over the past 3-4 decades. That's knowledge that you're not just going to be able to pass off in a month, but mentoring, coaching, that's where building that team from within, as you look to transition the business, becoming somebody who turns into that coach, who can take that knowledge out of your head and disseminate it to your employees. That's huge, because we don't want that knowledge to leave the business with you. Margins. This is another huge area that we're all thinking about right now, but managing those margins. And what I mean in particular is a buyer is going to pay you for what we call sustainable cash flow. So one of the things to do as you're looking at your margins and you're looking at your cash flow, look in those enterprise management systems and think about how much of my increase in revenue is due to volume versus how much is due to price. Because if we're growing the volume of the business, if we're selling more to customers, that's good. That's something that's sustainable. That's a good story to tell to a buyer. If we've just gone up by 30-40%, and that's primarily due, and we're talking revenue here, to just selling more at a higher price, then that's not really sustainable. And as a buyer, I'm not going to buy a price that is above where it was 1, 2, 3 years ago, because that's a variable that we don't have control over. So sustainable, and when you manage those margins, it's what is sustainable for this business going forward. Really take a good look at that and get those margins to a point where they are sustainable, and you know that they're sustainable regardless of exogenous factors like price. Diversify your customer base. This is a big one. And what I mean here is it's not just you sell to everybody. Figure out who your target client is. What's your niche? And then figure out how to sell more to that niche. And one of the things we ask for when we come in to do evaluation of a business is a list of your top 20 customers. We want to see that. We want to see concentration. If it's there, if it's not there, we want to know why, and we want to know who your target customer is, because this becomes really important. If I have my top 5 clients account for 40-45% of my business, there's going to have to be some really important relationship transitions that go on, so that I, as the owner, if I leave, one of my clients doesn't say, well, I was really used to dealing with Bob, so I'm going to go somewhere else. And that's critical, because as a buyer, I'm not going to pay for a client that might walk out the door or take 50% of their business somewhere else. And so again, sustainability, continuity becomes a key. And a couple other ones that are a little bit easier to do, and you can do without having as much of a lead time and as much learning going on. Have your financials audited. Nothing makes a buyer more confident than coming in and saying, okay, this business has had somebody look under the hood and give them their stamp of approval to what's going on here. The cleaner your numbers are, the easier that due diligence process is going to be. And finally, trailing 12 months. You've probably all heard about trailing 12 months. Most businesses are sold, especially in the merger and acquisition world, on a trailing 12-month cash flow, normally EBITDA, right? Earnings before interest, taxes, depreciation, and amortization. So if you know that there are extraordinary one-time non-recurring write-offs that are going to happen before a potential sale, the sooner that you write those off, the sooner as you expense those, the better. Because now you're just giving more time for those to flow out of that trailing 12-month period and show actual cash flow without this big, we have to write down equipment, or we had to write off some bad debt, stuff like that. We want to get rid of before a buyer really starts digging in and looking at those trailing 12 months. Value and marketability, they're very intertwined. A company that is more valuable is likely to be more marketable. And one of the things we see all the time, and we'll give you this example here, is think to yourself, given these facts, is this a company that you would buy? And when you are thinking about transitioning ownership of the business, whether it's to your family, key employees, an outside party, or maybe all of the employees, right, through an employee stock ownership plan or something like that, you need to put your shoes in the buyer's perspective to start asking questions of, would you buy your business? Or are there things that you need to shore up, things that you need to make run a little bit better? Because that all goes to marketability. And a business that's more marketable is one that's going to be more valuable, and you're going to get better offers for it. Like anything, if the demand is really high, the price is likely to go up. So think about your business from the perspective of a buyer. If you truly sit down and think about your business and say, would I buy my business? And the answer is either a head scratch or, geez, we've got some work to do. That's fine. We can make those changes, but you probably won't be able to take your business to market within the next 6 to 12 months. So timeline becomes important here. And so what's the solution, or at least what's the beginning of the solution? And in our experience, it's get an independent valuation as soon as possible. Even if you don't plan on selling the business in the next 3 to 5 years, knowing where you stand right now is really, really important. And any good independent valuation analyst is going to dig into more than the numbers. They're not just going to give you a number and say, oh, your business is worth $4 million. But they're also going to dig in and understand your operations. They're going to understand the processes you have in place. Where are you getting your revenue from? How are you managing your margins? So that they can help you start to understand some of the areas that can lead to a more valuable and a more marketable business. So really important place to start here before we jump into more of the technical details. So with that, I wanted to see, James, because this is a little bit more technical, if we have any questions outstanding, I'm happy to take them now so that we can make this a little bit more interactive.
No question as of
not a problem. Not a problem.
Anyone have any questions? Feel free to raise your hand, I guess, or put them in the chat or Q&A boxes, and we will get to them at any point.
Perfect. That's good. I actually just saw one come in, James, that talks about what type of advisors will I need during the succession planning process. It's a great question, and most of you already have a CPA. You've probably got a corporate attorney. So those are going to be two very important people. You're going to need, or you may need, an investment banker, depending on how you are going to sell the business, right? If you sell to a third party. You may also need your commercial banker, because somehow this has to get financed. And then ultimately, you're going to need somebody who's going to be able to value the business and coordinate all of these different service providers, because there's a lot of work that goes into this succession plan. And one of the things we really like to do on our side, and we pride ourselves on, is taking some of that responsibility off the owner so that we can coordinate with the professionals. And then we're bringing the owner actionable decision-making items so that they don't have to sift through, well, the accountant said this, but the lawyer said this. And nobody's paying you to coordinate the succession planning process. So there are a lot of people involved, but the key ones are going to be an accountant, a corporate attorney, possibly an M&A banker, possibly a commercial banker, and then a valuation/succession planning professional. So excellent question. So once we know what the business is worth, then we need to figure out, what do we do next? And from our perspective, what we like to do is, in a succession planning engagement, we value the business. And then the first thing we do is what we call a retirement or post-ownership cash flow analysis. And so we line up all your assets and we figure out all of the different cash outflows that you have, all right, as well as what you're paying yourself now. And we set it up so that it looks something similar to this. And this is taken actually from some work we had done a couple of years ago. But when we're talking about what you take from the business to fund your current lifestyle, we want you to consider everything. It's not just the income that you report on a W-2. It's bonuses and other types of distributions, depending on what type of company you are, dividends that get paid out of a C corporation. All of these things go towards funding your lifestyle. And some people will do things like they've got a country club membership on there, or they've got vehicles that they use for personal use. They've got some type of gas stipend. You know, all these things relate to how you live your life. And you really don't want, at all, if at all possible, that lifestyle to change a whole lot if you are not the owner of the business anymore. And so we want to take all those. We want to subtract out what may be coming in the future in the post-ownership. So for a lot of people, rental income. We may own the property where we operate and we can rent it back to a buyer. That's great. That's wonderful. You know, Social Security, any type of pension, anything like that that's set up for either you or your spouse, we're going to want to consider that, because then we can come up with what we call the income gap. And we can use that and throw in a couple factors in terms of things like growth rate of assets and how long you're planning to live post sale of the business. And we can come up with what we call a value gap calculation. And so what we'll do here is we'll look at, okay, what is that? What's the present value of those future cash flows that you're going to need from that income gap? And then let's look at what you have now and try to figure out, what do we need to do to close that gap? And the reason that we like to start with a valuation followed by this analysis is, if there is a gap, we need to know now, because the more time we have to fix it, the better. If we have to sit there and come up with a way to close this $700 and almost $20,000 gap, and you want to sell the business by the end of the year, it's just not going to happen. It's going to be very, very difficult, because there's generally a good reason why that value gap is there. It's probably because the business needs to make some changes to make it more valuable, and or there's other places that you can be putting money, right? Cash balance plans, make sure you're maxing out your 401ks, all of these different things that we can do, but it's easier to do it over the course of a couple of years. So this calculation becomes really important, because it takes that number from what your business is worth and it actually puts it into understandable terms of, will that help me to get from where I am today to where I need to be in order to make sure that my lifestyle doesn't change dramatically once I sell the business. So really, really important to run this calculation as early as possible. And just to make that point again, what you know you can plan for. So if you know where you start and you have a gap, then we can come up with ways to fix that. But if you don't start early enough, it becomes challenging. So just food for thought there, and how the valuation works into the succession planning process is through that post-ownership or retirement value gap or cash flow analysis. Finally, before we open it up for any other questions, I want to make this point. I'm going to make it on this slide and the next slide, which is net. Net value is really, really important. And what's the biggest drag on that? Typically taxes, right? There will be fees, right? You will pay transaction fees. You know, if you use a banker or a broker or somebody like that, they're going to charge probably a percentage of the transaction. lawyers, accountants, folks like us will definitely charge for our services, but that's generally not going to be the biggest drag, right? None of these people are charging 23.8% if you happen to be lucky enough to get all long-term capital gains. If not, it might be even higher than that, 30, 33, close to 40%, depending on if you live in a state that will also charge a state income tax. So whenever you are doing tax planning, and this is something we talk to owners about, and we work with their accountants, there are 3 phases. What do we do pre-sale? How do we structure the sale? And how does the payout happen post-sale? And all of these go towards focusing on that net. What's that net dollar amount that's going to come to you and your family? So a couple of things to think about from a pre-sale tax mitigation standpoint is, who's the buyer? Up top, we talked about, is it people who are internal? So is it a family member, or are you selling externally to a strategic competitor or a financial buyer, some type of roll-up? Becomes important because the tax brackets will be different. If you're selling internally, you're probably going to have to think about, okay, what's my tax bracket? What's the tax bracket of the people I'm selling to? Whereas if you're doing an external sale, it's generally, okay, I want to make sure I don't pay as much taxes. I'm not really too concerned with what happens with let's call it your competitor, your strategic buyer. They can deal with that on their own. Okay. Gifting or granting, are you able to use, for example, if you are lucky enough to have a family member, a child who wants to take over the business, or multiple children, can you gift some of the business and avoid taxes that way? But again, that plays into how much of the business's value do you need to fund that post-ownership. If your value gap is positive, which would be great, maybe you can afford to gift away $500,000 or $600,000 of the business before selling the rest of it to that family member. Okay. And finally, and this is something that John Wagner hits on a lot, is, will there be earnouts, seller financing, debt financing? How is the payout actually going to come? Because if you can spread that payout out over a couple years so that you don't take the whole tax hit in 1 year, that may be beneficial, and there are scenarios to run. The other thing is entity type. And this is something that we have to be very concerned with, because a lot of these businesses in the LBM industry are older. They may be C corporations. And at that point, we have to think about double taxation. Right? It's the stuff that gets taxed at the corporate level, and then it'd be taxed again when distributions are made to shareholders. So we have to look at that entity type and think about what might be the best way to transition ownership from a tax efficiency standpoint. So structure of the sale, and we'll get into this in a couple months in another webinar, a little bit more detail, but asset versus stock. Are you selling assets of your business and you're walking away, or are you selling the entire company? Are you selling your business? LBM Dealer Inc. Is that whole business transitioning, or are you just selling the net assets of that business? And so that's going to matter. All right. And one of the things that you have to look at is, depending on what type of sale it is, depends on what matters to you. Right. If you're selling the assets, then the allocation of the purchase price matters, because that's going to be the difference between you paying ordinary income potentially and long-term capital gains. If you're selling the stock, it's a lot more about continuity, making sure that customers, vendors, et cetera, get transferred to the new relationships so that they don't start scratching their heads and going, well, geez, I can't call you anymore. Who do I call? Right. And finally is this idea of worker ownership, which is an interesting one, because when we talk to folks, lots of time their first reaction is, I really like my people, but the guy that drives the forklift in the yard, he can't run the business. And the whole idea behind employee ownership is not to have, you still have a management team. And in many cases, you may be able to stay on as the CEO or in emeritus position to help transfer the company. But ultimately what you're doing is 2 things. Number one, you're selling the business to the people who know it the best, which are your employees. and you're maintaining a leadership team that still runs the company. But from a tax mitigation standpoint, especially if you're a C corporation or an S corporation or an LLC that's taxed as a C or an S corporation, there can be some pretty big benefits. And I'll give you an example. So if you sell more than 30% of the stock in the business in year one to, let's say, an employee stock ownership plan, and you take those proceeds from the sale within the first 12 months and invest them in what are called qualified securities, which essentially means individual stocks and bonds of U.S. corporations, you can defer the capital gains taxes on that sale indefinitely until you actually sell the assets that you invested the sales proceeds in. So in some instances, this may be the employee ownership route may work very well for everybody involved and provide some significant tax benefits to the owner and their family. And then finally, what do we do post-sale? It's the risk versus tax. You get your lump sum up front, that's great. You've got your money, there's no more risk in it. But you're probably going to be paying a lot of it back in taxes, as opposed to, is there some type of payout over time? And then, of course, what is that payout, right? And part of that payout is going to come from how sustainable the cash flow is, and that gets into the earnout piece of it. A lot of times when you sell, especially to a strategic third party, they're going to want to make sure that the business relationships that you have don't walk away if you do. So there may be a 12-month earnout where you have to maintain margins at a certain level through that. And we would suggest basing it on gross margin. But anyways, the point is that understand how the payment to you impacts your taxes. And then, as we said before, if you own a C corporation, it can get a little bit trickier because there's typically double taxation here, once at the corporate level and once at the individual level. So understanding how we can get around, are we going to have do we need the money right now, or are we going to have the money paid to the C corporation? We'll pay taxes right now at the corporate level, but maybe we'll keep the C corporation open and slowly distribute to the shareholders over time to break up that second level of taxation. Right? That can be one strategy. Another one would be to look at the worker ownership. But within all of this, we have to be thinking about what we're paying in taxes and then our income stream. And so as many of you have already done, splitting out your real estate can be a great way to not only mitigate taxes because it brings the selling price down, but also it's a stream of income. Right? You can rent that real estate back, and then you have some control over the income that you're receiving. So really, the whole part about tax planning is get the valuation, figure out that retirement cash flow analysis, and then start thinking about how you're going to transition that business. If the business is worth $5 million, great, that's gross. But let's make sure that we figure out how to make the net the most to you, and consider all your options here. And that's one of the things that, from our perspective, we're totally agnostic. We want to do what works best for your company. So we're not going to push you to try to sell to a family member, or to try to sell to your employees, or to sell, through an investment bank or anything like that. We want to sit down with you. We want to work the problem and come up with the right solution that is ultimately a win for you as the outgoing owner. But we know how much you care about the other stakeholders in the business, your employees, your management team, your customers, your vendors, all these people. We want to try to create as many positives out of this as possible. And that's, again, consider all your options, start early, and be flexible. So with that, we're running up here between 30 and 40 minutes. So thank you very much. Reach out anytime. We are happy to take complimentary consultations with anybody. If you just have some burning questions that you might not feel comfortable asking in a large setting, shoot me an email, give me a call. Happy to talk those through. And as James had mentioned up top, we'll be at the LBM Strategies Conference. So happy to set up a meeting there if that would also be helpful. So with that, James, I'll turn it back to you for any questions that may have come up throughout the presentation.
Yeah. Yep. Question is it important for me to charge market value for properties I own?
Yeah, good. So good question. And this comes up a lot because if you own the real estate where you operate, a lot of times we'll see folks either won't charge rent or they won't have any lease agreement. So let's say you have your company and then you own the real estate in a separate entity, right? And the company then leases the real estate from this separate entity. Lots of times what happens is folks will charge lower than market rent, or they might not even charge any rent at all, just because it might make the books look better or they've got more cash flow. The problem there is that when we do evaluation, we are always thinking, what would a hypothetical buyer do in this situation? And what they would do is they would say, no, wait a second. I'm not going to be able to rent that property for free. So that's going to cost me money. And they're going to go to market rate. Well, what happens? Expenses go up, net cash flow goes down, and that impacts the actual sustainable cash flow of the business. So providing a realistic look at those market rates and charging yourself, so to speak, a market rate is just a good way to get a better idea of what that realistic sustainable net cash flow is.
Question I had as you were going through is I think, come across the news more and more ESOP plans or succession options. Is that something that is a trend now that wasn't previously, or is that kind of always been around?
Yeah, no, excellent question. So this idea of employee ownership and has been around for a long time, right? I mean, cooperatives themselves started back in the 20s with farmers, but it hasn't been a huge part of the independent business succession planning community, primarily because a lot of them could pass the business on to children or nieces and nephews or somebody within the family. But nowadays, it is starting to become more popular just because of the fact that what was the primary option, which was selling the business to my kids, let's say, it's not as likely, right? The probabilities have gone way down that your children will want the business. And so the idea of employee ownership is right there next to, well, I sell to my kids, that's great. But if I sell to my workers, they know the business, right? They work in it every day. I don't have to necessarily turn over the business to just anybody, right? There's still a management team that runs the business, but it's to my workers. They have more buy-in now, right? Because they are owners in the company. And then I think what has gotten overlooked for a long time, just because the values of businesses 50, 60 years ago weren't what they are now, is the tax piece, right? From the owner's standpoint, there's big tax benefits if it's structured correctly to going this route. And so it can really be a win for everybody if you do the ESOP route. And with an ESOP in particular, what it is essentially is you're setting up a retirement plan for your workers and funding it with shares of the business. And so now part of their retirement is based off of how much their shares are worth in the business, which in theory and hopefully will incentivize them to work harder to increase the value of the business, because it increases what they'll get at retirement from their ESOP plan.
Sure. Thanks. Do have another question just popped up. What kind of multiples of earnings are you currently seeing?
Yeah, good question. So they're still fairly high, right? EBITDA, we're still seeing EBITDA, 4.5 to a little bit over 5. But it's going to depend on where that EBITDA comes in, right? Both as a percentage of revenue and just in terms of what is that adjusted sustainable EBITDA. So I'll take the first part. depending on the mix of the business, 10% is usually a good place to start. So if you take your earnings before interest, taxes, depreciation, and amortization divided by revenue, if you're somewhere around 10%, that's usually a good starting point. And again, it's going to depend on the mix. If you're just selling lumber, which most people aren't doing nowadays, but if you're just a wholesaler, let's say, it's probably going to be a little bit lower, right? Your margins are lower. You're not going to be able to mark things up. If you have some value add, maybe you're doing truss manufacturing, windows, doors, something like that, you can get over 10%. That EBITDA to revenue ratio should be over 10. And then people are really going to start looking. If we're getting a 12%, all right, that's good. So those are good metrics to shoot for. The other is just on a sustainability. So when we come in and we value a business, we're going to make a lot of adjustments. Right? We're going to make sure that rent's at market rate. We're going to make sure that owners are being paid at market rate. We're going to make sure that family members who are on the payroll aren't there anymore, right? Because if I'm buying the business, I'm not taking on payroll for mom or grandma or whoever. Depreciation, right? It makes sense from a tax standpoint nowadays to expense. You can expense a lot more equipment, and that from a tax standpoint, that's great. But from a sustainable cash flow, you didn't have to expense that. So let's look at what the depreciation is over the useful life. That'll increase that net cash flow. But there are a lot of adjustments we'll make. And so then we'll start looking, right? Over $1 million, $1 to $2 million, that's solid. $2 to $4 million of EBITDA. Now we're starting to really hit a sweet spot, and anything over 4, that's a really, really good business. That's a very marketable business. I will say though, it's hard to get there. So that 2 to 4 range is a good place to shoot for ultimately. But remember, it's also sustainable, not just the EBITDA that has been driven by the last 2 years of really, really high lumber prices. So you're best off going and talking to somebody who knows the industry and has done a lot of these valuations so that they can be really objective and say, okay, this is what we think is actually sustainable if we were coming in and buying your company. But yeah, so just to review that 10% is a great in terms of EBITDA to revenue, and then 2 to 4 million in terms of just adjusted sustainable EBITDA number. Yeah, those are great metrics to keep in mind.
All right. Don't see any other questions up. Anyone have a question? Feel free to jump on the Q&A or chat option. And
feel free to follow up at any time. We're happy to take those questions whenever they pop up. So you may think of something in a week or a month. Don't hesitate to reach out.
All right. Well, Sam, I think that's, just have another here too. Why would I consider employee ownership if I don't think my workers can run my business?
It's an excellent question. It's actually one we hear quite a lot. And my response to that would be, don't worry, your workers don't have to run your business. There's still a management team. And in many, many worker-owned companies, they'll bring in an external CEO, CFO, top-level C-suite management to run the company. The primary difference with the worker ownership is that just like in a larger C corporation or even an S corporation, there's a board that's made up of the worker owners that does some oversight. So if you've got a CEO that for years you've been selling to custom home builders, and now they want to start selling to the D.R. Hortons and Lennars and people, the employee owners can then say, no, wait a second, that's not why we brought you here. And so I think that's really important to remember, is that there is a check on the leadership, but the leaders themselves can be very seasoned, very knowledgeable people. So I think that's important. The second piece of that is your workers know your business. And if you have a good workforce, they're going to be great people to turn it over to, because there's continuity, right? If I'm buying from your business, and so fine, if James sells his business and I'm one of his workers, maybe you as a customer aren't going directly to James, but you know me, and James can transition that relationship to me. And that becomes really important for continuity, because then the customer doesn't feel like, geez, I'm having to deal with people. I don't know these people. Why do I want to deal with them?
Another question. This is good. If higher interest rates reduce M&A activity, what options do I have to sell my business?
Yeah, and it's always hard to tell exactly what will trigger a cycle to slow down a little bit, but higher interest rates could definitely be one of them, right? It's a borrowing cost thing, and since most of these are going to be leveraged deals, they're going to use some type of borrowing. So the more expensive it is to borrow, they're not going to be doing as many deals, these larger companies, whether it's a US LBM, a Kodiak, or even your competitor, regionally or locally. So a couple of things here. Number one, make your business as profitable as possible, right? Look at that bottom line EBITDA number. Good businesses still sell, even in difficult markets. If you have a good business with a really defined customer base, and you've done a good job of disseminating your knowledge to your team, it's probably going to show up in your profitability. So if you can show a couple of years of improving profitability, even in a rising rate environment, you're going to have a business that's more marketable. And so there is a possibility that it can get bought out by one of your competitors. So that's definitely one thing to think about. The other is the questions we've just been going over is, I wouldn't sleep on the worker ownership piece, because it's very, very valuable from a tax perspective, and you can get paid a market rate for your company. So it's not like you have to take a reduction. If my business would be worth $5 million, let's say, to a strategic buyer, it's not like you would have to take $3.5 million if you sold to your workers. But you can still get that market value of $5 million. The payout may look a little bit different, but you'll be able to transition ownership of the business, and you'll be able to do it in a way that's tax efficient to you, provides buy-in for your employees, longevity for the company, and for many of us, it's a community thing, right? We employ a lot of people in the community, and so we don't want to just sell the business to anybody. And so don't sleep on the worker ownership piece of it. And if you have more questions around that, please let me know. I'm happy to dive into details and answer questions and discuss concerns.
All right, thanks, Sam. We're closing in on about 50 minutes here, so we should probably wrap up. But I want to remind everyone, the contact information is right there if you want to reach out to Sam anytime after this. And also a reminder, he will be at the LBM Strategies Conference coming up this October in Denver.
Excellent. Yeah, thanks, James. Thanks, everybody.
Thank you. Everyone have a great day.
Yep, take care.